Good evening, ladies and gentlemen. This is Barry Norman on behalf of Trade Fred, and welcome to our webinar on risk management. Now, tonight's class is sponsored by Trade Fred. Yes, an unusual name, but a great broker, Trade Fred. Easy to remember. They offer tight spreads, fast withdrawals. They're a regulated broker, so all your funds are segregated. They have superior performance. They have dedicated support, an incredible range of tools, and a depth of education that you won't find with any other broker. They offer a lot of trading resources, including their news and blog, their daily reviews, the economics counter, and live trading signals. You can also attend their Forex Academy to learn how to become an independent trader. Now remember, when you trade with Trade Fred, all of your funds are segregated so you know your money is safe and sound. You have a dedicated client support network. You are dealing with a broker that is regulated by the CISIC, the Cyprus Securities Exchange Commission, which also passports them throughout Europe. And they're also a member firm of the Investors Compensation Fund, so all of your funds are also insured. Now, because Trade Fred is a regulated provider, I have to give you a risk warning before we start the webinar. So let's get through that, and then we'll get started learning about risk management. Trading the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks and seek independent advice if necessary. Trade Fred provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only and is not intended to be a personal recommendation. All traders must understand that there is a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Hence, we should always use the best risk management we can possibly use. And that's what tonight's class is all about. But when you trade with Trade Fred, you have choices of several different platforms. You can trade on their live online platform, which you simply log in and you can start trading from any computer anywhere. You can also use their mobile platforms, and it's one of the most advanced mobile platforms out there for any handheld. Or you can download their MT4 World's Class platform. They also offer you free signals directly on the platform as you're trading, giving you indicators, direction, and everything else you need to know. You can also click up Notify Me, and it'll send you immediate notifications even if you're not logged into the platform. So tonight, we're going to be discussing risk management. Now, tonight's webinar is being recorded, and if you wish to see a recorded version of this webinar after the class is over in about 24 hours, you can do that by going to www.investing.com, exactly where you came to sign up for the webinar, and look under Education tab, and then look for Webinars on Demand, and you'll be able to see a recorded version of this class in about 24 hours. Now, one of the key reasons that a trader should have a trading plan is that they can incorporate their risk management into this. Now, many novice traders begin trading without any type of plan. They just think, they can log in, they can figure it all out, and they can start trading and make tons of money. And this is one of the primary reasons why the vast majority of new traders lose money. Even with a trading plan, if the plan lacks a good risk management component, regardless of how well you plan and how hard you work, a trader can eventually lose everything. And I guarantee you, every time I talk to a new trader and they've lost their initial deposit and their initial investment, and they want to blame everybody, they don't ever want to blame themselves. And the fact is, if you use a proper risk management theory and a proper risk management exercise, proper risk management, you should never lose your entire investment. because risk management is all about keeping you in the markets until you can turn a profit, and also not giving that profit back to the markets. So remember, expect the unexpected. Strict money management and risk control is essential to achieve long-term success in the markets. The high level of leverage available to traders makes it important to manage risk exposure and to avoid over-leveraged positions. Successful money management aims foremost at the preservation of initial trading capital. So remember, it's very, very easy to go sign into a platform and see for $175 or $649, you can tie up $50,000 or $100,000 of an asset. But the fact is, you have to, at the same time, say to yourself, okay, I could make $1,000, but for every dollar you can make on that trade, you can lose an equal amount. And this is why a leverage is a two-edged sword, and it's addictive. Once you start using leverage, especially if you made a quick profit using leverage, you never want to reduce your leverage, and you never stop to think, oh, maybe I should reduce the size of my trade. You get cocky. Now, leverage can be defined as the amount of a trading position you can control with any given amount of margin. Money, in other words, money placed on deposit as collateral. Also, the leverage ratio is the ratio of the amount of leverage to the amount of margin. In practice, a leverage ratio of 50 to 1 would mean that you can control $50,000 worth of a position for just $1,000. Well, remember, leverage or a margin is a simple deposit. It is not just how much you can lose. It is a deposit. So like anything else, what you have when you put a deposit down, you still have the responsibility of that entire asset. Now, granted, you're not going to see a $50,000 of investment turn into zero overnight, but you can sure see a $50,000 investment turn into $40,000. And even though you just put up $1,000, that's not your loss, that's your deposit. You could still face an additional $9,000. And that's crazy, risking that kind of money for that kind of loss, unless you have a huge account. While professional forex traders generally trade using the credit lines that banks and their counterparties extend to each other, retail forex traders like you and me have to master this concept of leverage, since they are usually required to trade on margin rather than credit. So yes, when you see about these big investment houses, these big hedge funds, or Warren Buffett making a multi-billion-dollar trade, they don't really care if the markets move against them for a minute, because they have the funds and the credit lines to ride out that move. So in other words, if the euro was trading today at 129 and you think it's going to go to 131, but in between it drops to 119 or 120 or 121 for just a blip, something crazy happens in Europe. Well, you know what? If you have the tons of money to wait it out, you'll eventually be able to sell at a profit. But you and I don't have that. We have to cover our loss. We have to have enough cash in our account to avoid a margin call. And we only have so much risk that we can put in a trade. So naturally, this high leverage ratio can act as a two-edged sword, since losses can accumulate as quickly as profits on large positions. Nevertheless, if you have accurately called the direction of the market, you stand to make good money on your rather small initial investment. And boy, does that sound good, doesn't it? But that's the problem. It sounds enticing. Furthermore, traders need to keep close track of their margin requirements for open forex positions, since many retail forex traders will simply close out losing positions when a situation arises where the margin in the trading account has been used up due to adverse market conditions. Now, for us, we need to place what's called a stop loss. That's where we instruct the computer, hence our broker, to close our position if the market moves against us, because we have to determine how much risk or how much loss or exposure we can take per trade, because we don't want our account wiped out. So the excitement of real-time trading and the thrill of seeing an investment rise or fall can sway anyone. That's why finding an appropriate trading style and staying with it is crucial for risk management. Staying detached and objective about an investment while keeping emotions in check allows for clear thinking required to make appropriate trading decisions. Keeping a neutral outlook as trading occurs allows the larger picture to be evident and ensures that the planned trading style is fulfilled without being biased by temporary changes. Now, an experienced trader, a well-known trader, looks for better strategies that they've tested longer and better. Okay, but they're not looking for a strategy that's more complicated. They're not jumping from strategy to strategy because what they know is all they're trying to do is move the odds in their favor a wee little bit, and at the same time that they're managing their risk at all times so that they don't ever lose their profit and they're not chasing their capital. So one of the most important rules is when losing in trade after trade, lower your trading size by as much as 50%. Too many traders want to go chase their losses and keep increasing their position size or making more and more trades. And they start chasing that profit or chasing or trying to recover from the losses. Go even smaller if needed, or even take a break from trading. This is one of the most important rules you can learn about risk management. 2, only risk 1% of your capital per trade. Now you're going to say to me, Barry, I've only got $1,000. 1% means $10. Well, unfortunately, if you only risk $10 per trade, and that's a very, very small trade, it makes it difficult to place your stop losses, difficult to open up position large enough. So how do you offset that when you have a small account? You make less trades that have, and only make trades that have a higher success rate. Okay. So only risk 1% of your capital per trade. While this is standard, you must avoid the temptation to trade big to make up your losses. This usually compounds the problem because the market is not cooperative with your style during a downtrend. 3, stay disciplined with all of your entries and exits. Do not get sloppy. One of the main reasons to build a trading plan, not a risk management plan, because risk management is incorporated in your trading plan, not a trading strategy, but a trading plan. A trading plan incorporates every bit of every trade, from how you're going to analyze it to how much you're going to trade to when you're going to trade to where you're going to put your stop loss, because it will stop you from getting sloppy. Because sloppiness tends to lead to losses, which tends to lead to wiped out accounts. Now, do not abandon your method. You have to stay the course, so when your method comes back in favor, you will start winning again. Trading strategies go in and out of favor, depending on whether we have a volatile market, a non-volatile, we have an uptrending, a downtrending, we have a sideways. Okay, it doesn't mean you're using a trading strategy that works successfully for you. Today, you had a couple losing days. Don't throw it out the window and try to start a new trading strategy or a new plan. Reduce your investments, reduce your risk, make less trades, and wait for the market to turn around, not go up or down, but turn around so that your plan or that your strategy is start working again for you. If after a while you see that it's not working, and that doesn't mean you're losing money, because when you see that your strategy isn't cooperating with the current market, you can flip over at any time to a demo account and keep using that strategy in a demo account and see how you're doing with it. And when it turns back into making profit, then you can move it back to your real money account. Because sometimes the best way to wait out a market is just trading in demo for a while. So don't take, and the biggest thing I find when I'm talking to new traders is they get aggravated, they get annoyed, they get emotional, and they take their losses personally. It's not your fault that the market is not conducive to profits if you are trading your proven system. Okay, if you've got everything worked out and you have a loss, don't get mad. Now, when I was in college a long time ago, a very long time ago, to pay for my room and board and my living expenses, I used to do, it was a fundraiser for the Democratic National Committee in the U.S. And I used to spend my evenings on a telephone calling looking for donations to whatever political person, whatever politician was running for office. Now, my sales manager once said to me, Barry, don't get upset when somebody hangs up or won't talk to you or it says, call me back later. Okay, because we know statistically you're only going to get one donation for every 10 phone calls. So if you think of every hang up as one step closer to your success, you won't get so upset and you won't take it personally, and you'll keep that positive attitude until you get the positive results. And this is very important. If you get very personal, very negative, you'll see it follows it over to your trading. Now, do not fall into the temptation to let losers run. This is one of the worst things out there. You need to set in your trading plan your take profit level, your stop loss plan, when you're going to exit the market, if the market, and what you expect to happen while you're in the market. And if the market doesn't react or perform the way you think it should be, that asset, you get out. Okay. And you don't start moving your stops. So you don't chase losers. Too many people say, I'll move my stop loss down a little bit farther and let it, maybe I'll take, maybe risk $150 instead of 100 because I know the euro is going to turn around, bounce back up. Fact is, later in the day it does, but it didn't just fall 150; it fell $250. So you didn't have the money to cover it. So your stop loss kicked in anyway. So instead of clicking in at $100, you clicked in at 150 where you moved it to, and you're now out 150 instead of 100. So cut your losses at predetermined stops, regardless of the pain. Do not stop tracking your watch list for the markets you trade. Be ready to take the right entry when it presents itself. Many traders get so beat up on a string of losses that they stop focusing on their watch list and stop taking high probability entries. You have to be ready to jump back on the boat when it is ready to sail again. Just don't drown while you're waiting to reach the shore. So one of the best, like I said, one of the best solutions I can tell you is if you're having a bad trading day, it's hard to close your accounts. It's hard to close your computer and walk away. Click the little button and move over to your demo account. You want to trade, but trade in demo so you're not risking any money, and wait till you see what's happening or what's wrong with the market. Sometimes a little bit of luck isn't running your way. Sometimes the markets are going crazy. Sometimes they're all anticipating something. But always be in control. Where you want to be is always in control, never wishing, always trading, and always, first and foremost, protecting your butt. That's why most people lose money as individual traders, investors, or traders, because they're not focusing on losing money. They need to focus on money that they have at risk and how much capital is at risk in any single investment they have. If everyone spent 90% of their time on that and not 90% of the time on pie in the sky ideas and how much money they're going to make, they will be incredibly successful traders, said Paul Tudor Jones. It's crucially important. Online trading, especially with CFD and forex and high leverage, becomes very attractive and very addictive. Many traders don't spend the time on doing proper analysis. They just want to jump in the markets and trade. If you can change your focus to only deal with high probable trades and less trades. I mean, the average day, I don't ever execute usually more than one trade. I very rarely have two open trades in the market at any given time. And usually one of them is a day trade and one's a swing trade. In a month, I might execute a total of 20 trades. And a lot of those were longer term 2 or 3 week trades. Because if you can find your enjoyment in doing the analysis, building a trading plan, fulfilling your trades, and also the analysis after the trade is over, you'll find that you make less trades, but you'll make more successful trades. So online trading is set up to be a rather risky endeavor. I will always encourage new traders to go easy on the risk as they get started. The system is somewhat rigged to encourage risky behavior. It's not a rigged system. Don't misunderstand me. It's not rigged that somebody's giving you phony numbers or anything else, but it's set up that you can make lots of profit and you can get snookered too easily by easy, fast money. So let's get first things first. The number one thing that you do to manage your risk is to never trade money that you can't afford to lose. Sometimes people skip this one thinking, that won't happen to me, but it really will. If you're trading money that you can't afford to lose, and you lose significantly, or even face the threat of losing significantly, your decision making will become compromised and mistakes will make. Do you know how many times I get calls from traders asking me if I'll manage their account? I don't manage anybody's accounts. Or, can you help me? I need to cover my mortgage next month. Or I can invest $2,500 instead of $1,000, but I need it back next month to pay my bills. You know what I say to them? I say to them, keep your money, pay your bills, go get a part-time job. Because trading can only be with not money you want to throw in the trash can. It's money that you can afford to lose, because then you'll make the proper decisions. When you have to make the profit or you have to have the money, you make crazy decisions. Because if you have a small loss, then you're immediately, I have to recover that loss. Because I can't pay my electric bill next month. Well, there's no guarantee you're going to make that money back next month. It may be 5 months from now before you have a very big successful month. But who cares if eventually you end up with a positive account and you never lost your initial capital and you ended up down the road finally turning a nice profit? That's all that you care about. That should be the only thing you're focused on. The second important thing is that you need not let your eyes be too big for your stomach. If you don't know what that means, it means start small. Make your trade sizes appropriate for your account balance. Now, U.S. brokers offer traders the ability to make a 50-to-1 ratio trade. Depending in Europe, it depends on where it's regulated in each country. Now, the regulators are talking about changing it to 30-to-1. Okay. But that's still a big risk, 50-to-1 or 30-to-1. This means you shouldn't be opening $100,000 trades with a $2,000 account. There is no need to make huge percentages every day on your money. It's more important to make continuous percentages rather than large ones. If you think that a bank is offering you 1% interest on your money, a big investment house, if you have $1 million or $2 million, will offer you a 5 or 6% return in a year. Why do you want to come trade forex or CFDs and think you can make 1,000 to 2,000% profit? Now, a stop loss is a type of order that does exactly what it says. It stops you from losing any further money from your account. Now, if you don't know what a stop loss is and you don't know how to place them on your broker's platform, you should learn very quickly, because you should never enter a trade that you don't have a stop loss. A stop loss is an order through the computer that tells the broker to automatically close your account if the asset moves against you so much money or so much percent. It's your parachute to cut your losses. It protects you. But the trick is to set your stop loss in a spot where you know the trade will reach if you are totally wrong with your trading idea, but where the market volatility won't stop you out and turn a winning trade into a losing trade. So imagine the euro's at 121. You think it's going to go to 122, 100-point profit. That's a nice profit for you. But you can only afford to put your stop loss at 120.50. That's all that you can afford, because all you can afford to risk is $100. But when you calculate the swing of the market and look where you should actually have to place your stop loss so that you don't get stopped out by just the market swinging up and down, and you realize you have to put your stop loss at 120, well, it's saying to you, uh-oh, we got a problem here. You can only afford to put your stop loss at 120.50, but just the average movement of the market means you have to place the stop loss at 120. So right away, what's happening to you? The hairs on the back of your neck should be standing up saying, do not make this trade, because you cannot afford to take the risk that it takes to just stay in the market. And that's what's very important. It's not where do I need to put my stop loss to stay in the market? It's where do I need to put my stop loss to cover the risk that I can afford to take? And then where do I have to put my stop loss to cover the swing of the marketplace? And if one isn't equal or better than the other, then you don't make the trade. Stop losses should be considered to be your emergency exit. They should be set to execute when your trade has gone horribly wrong. Now, I've seen many traders place their stops at a price where they might be wrong, or even worse, could possibly be wrong. If you set your stops too close to your price, it's going to get hit. It's just Murphy's Law. Now, if you spend the time doing education and learning, you'll find that there are different kinds of stop losses. You have trailing stop losses that will help you protect your risk management or your investment. You also have stop loss and exit strategies. For instance, when a market moves in my favor, I'll close out half of my investment at a small profit, keep the other half riding, and move my stop loss up closer. As the market moves a little farther in my favor, I'll move the stop loss up higher, so that even if the market turns against me at this point, I won't have any loss, because my stop loss is now at my entry point. And if the worst comes to worst and I get stopped out at that point, I already have some profit because I sold my half of my investment. But this is a exit strategy and a risk management profit loss protection strategy. So while managing losses is paramount to a forex trader, another way to keep trading risk at manageable levels consists of recognizing when a profitable trade has run its course. This third risk management concept involves using a trailing stop loss to protect profits as a position moves in the desired direction. Many traders make an initial move of their stop to break even once 100 pips or so have been achieved. Moving the stop even further towards the present spot rate will further protect gains once a trade has become even more profitable. When a profitable trade has run its course, perhaps by observing a set of mutual confirming technical indicators, that point to a reversal, an efficient trader needs to close out his position. So we have to stop and put it all together. Trading with money that you can afford to lose in the worst case scenario, trading with reasonable lot size, and controlling your risk with stops will prevent you from having a major trading disaster. These steps won't prevent you from losing money, but they will give you a chance that you will survive. Far too many traders take a Wild West approach to trading, and sometimes it works for a while. But when it's over, it's really over, and they tend to walk away with empty accounts. Trading while keeping your risk low will keep you in the game and put money in your pocket at the same time. Forex trading is a legit thing, but you have to be wary of the setup. You can make money if you don't get carried away taking on too much risk. This is not gambling. Speculating as a trader is not gambling. The difference between gambling and speculating is risk management. In other words, with speculating, you have some control over your risk, whereas with gambling, you don't. Even a card game such as poker can be played with either the mindset of a gambler or with the mindset of a speculator, usually with totally different outcomes. Take profit orders is another way. Take profit orders will generally be set to close out some or all of a trader's existing position at a better rate than are currently available in the market. Take profit orders are usually executed when the market is bid at their level in the amount required to sell that order. So what you can do is if you learn proper order entry, and if you notice, very little of we talked about tonight is strategy. Understanding order entry and types of orders. Okay, you can put a take profit order. Say again, you think the euro is going to go up to 121. You're buying at 121. You need to put your stop loss at 120. You figure out you can afford to do that. You figure the markets can go to 122. Okay. Now you can put a profit order at 122.25, and if the market ever surges up to that for 1 second, the computer will close out your trade, and you'll actually make more profit than you intended. Now, the whole idea is to stack the odds in your favor. However, no trade should be taken without first stacking the odds in your favor. And this is not clearly possible. If this is not clearly possible, then no trade should be taken at all. Now, there's things like using hedges. The main reason that you want to use hedging on your trades is to limit risk. Hedging can be a bigger part of your trading plan if done carefully. It should only be used by experienced traders that understand market swings and timing. Playing with hedging without adequate trading experience can be a disaster for your account. But you can master hedging by using a demo account. Now, some brokers allow you to place trades that are direct hedges. Direct hedging is when you are allowed to place a trade that buys a currency pair, and then the same time you can place a trade to sell that pair. While the net profit is zero, while you have both trades open, you can make money without incurring additional risk, because when the market jumps up, you close your up trade, and when the market falls down, you close your down trade, and the net is the net profit. Or if the market goes up, you sell your up trade and close out your losing trade. But as long as you make more profit than loss, you end up with a net profit. The way of a simple forex hedge protects you is that it allows you to trade in opposite directions of your initial trade without having to close your initial trade. It can be argued that it makes no sense to close the initial trade for a loss and place a new order at a better spot. This is part of a trader's discretion. As a trader, you could close your initial trade and enter the market at a better price. The advantage of using hedge is that you can keep your trade on the market and make money with your second trade that makes profit as the market moves against your first. When you suspect the market is going to reverse and go back to your initial trade in favor, you can set a stop on the hedging trade or just close it. Now, there's also complex hedging methods. This is not really for beginning traders. But a forex trader can buy a hedge against a particular currency by using two different currency pairs. Now, this is another way. If you understand the relationship between different assets, like gold and silver, the dollar and oil, or the dollar and the euro and the Swiss franc, you can use one to hedge the other. So for instance, you could go long the euro US dollar and go short the US dollar Swiss franc. In this case, it wouldn't be exact, but you would be hedging your US dollar exposure. Now also, remember the 2% rule. 2% or less per trade is highly recommended guideline for everyone to follow. We stress guideline because it depends on other factors besides your experience, like your trading system, mainly how often it makes trades. The more currency trades you take per time frame that you focus on, the less you want to risk per trade. But the 2% rules: never have more than 2% of your total capital in the market, not per trade, totally in the market at the moment. Also, don't forget to factor in changing market volatility and any adjustments to your entries and exits. Another way to you can increase your chance of profitability is to trade when you have a potential to make 3 times more than you are risking. If you're giving yourself the 3-to-1 risk reward ratio, you have a significantly greater chance to end up with profit in the long run. Because what it does, it takes all of those low probability trades off your plate and only leaves you with high probability trades. Okay. It means you're trading less, but your chances of making sizable profit is higher. So if your broker offers a 2-pip spread, now you have to understand spreads also. You'll have to gain 11 pips instead, because you need to cover your spread at all times. If you were to reduce your position size, then you can widen your stops to maintain your desired risk reward ratio. In other words, make smaller trades and you can keep a larger position. You can keep a larger stop loss. Now, if you increase the pips you want to risk to 50 and you need to gain 153 points at the 3-to-1 ratio and covering your 3-pip spread, by doing this, you are able to bring your risk reward ratio somewhere nearer to your desired 3-to-1. Not so bad, huh? So again, by making smaller spreads, by making smaller lot sizes, smaller trades, you can then increase your high probability trades. In the real world, reward to risk ratios aren't set in stone. They must be adjusted depending on the time frame, trading environment, and your exit and entry points. A position trade could have a reward to risk ratio of as high as 10-to-1, where a scalper might be using a 0.7-to-1. But a smart forex and CFD trader would never enter a trade with less than a 3-to-1 win-loss ratio. But remember, risk is inherent in every trade you take. But as long as you measure risk, you can manage it. Just don't overlook the fact that risk can be magnified by using too much leverage in respect to your trading capital, as well as being magnified by a lack of liquidity in the markets. With a disciplined approach and a good trading habits, taking on some risk is the only way to generate good rewards. And on that note, I'm going to say goodnight to everybody. Again, go to www.tradefred.com. It's an easy name to remember, TradeFred. Go meet Fred. And you can open a demo account, sign up in some of their initial education to Forex Academy, and you can learn more about how you would actually calculate your risk reward and where to put your stop losses and the different kind of order entries that you should have. And give yourself a fighting chance. Remember, use a demo account. Don't overtrade. Trade high probability trades and test your trades, or when you're not doing so well, just flip over to your demo account and wait for the markets to move in your favor. So thank you very much. And again, give TradeFred a try. And remember, you can go see a copy of this webinar, the recorded webinar, tomorrow on investing.com. Have a great night, and thank you for trying TradeFred. Good night now.